Well, we think first in terms of business risk. You know, the key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. So we're thinking about business risk. Now, business risk can arise in various ways. It can arise from the capital structure when somebody sticks a ton of debt into some business, and so that if there's a hiccup in the business, that the lenders foreclose. It can come about just by the nature of the business. Certain businesses are just very risky. Back when there were more commercial aircraft manufacturers, Charlie and I would think of making a commercial airplane, a big airliner, sort of as a bet your company risk, because you would shove hundreds and hundreds of millions of dollars out into the pot before you really had customers. And then if you had a problem with the plane, the company could go. There's certain businesses that inherently, because of long lead times, because of heavy capital investment, that basically have a lot of risk. And commodity businesses have risk unless you're the low-cost producer, because the low-cost producer can put you out of business. Our textile business was not the low-cost producer, and we had a fine management, and everybody worked hard. We had cooperative unions, all kinds of things, but we weren't the low-cost producer, so it was a risky business. The guy who could sell it cheaper than we could made it risky for us. So there's a lot of ways businesses can be risky. We tend to go into businesses that inherently are low risk and are capitalized in a way that low risk of the business is transformed into a low risk for the enterprise. The risk beyond that is that even though you identify such businesses, that you pay too much for them. That risk is usually a risk of time rather than loss of principal, unless you get into a really extravagant situation. But then the risk becomes the risk of you yourself. I mean, whether you can retain your belief in the real fundamentals of the business and not get too concerned about the stock market. The stock market is there to serve you and not to instruct you, and that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher, because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is and we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings, because it means more things are going to get mispriced. Actually, volatility in recent years has dampened from what it used to be. It looks bigger because people think in terms of Dow points so they see these big numbers about plus 50 or minus 50 or something. But volatility was much higher many years ago than it is now, and you had the amplitude of the swings was really wild, and that gave you more opportunity.